Devang Mehta also joining us this morning. Devang, markets look like they're set for another slightly tumultuous day given what's happening globally. How are you viewing the recent developments? How are you strategizing in light of it?
Good morning, Abha. Thanks for having me on the show. I think clearly what we have seen over the past 4-5 days is that market has been a little more turbulent in terms of falling down, as well as what we have seen is even the market breadth collapsing. And yesterday's market, while it opened gap up, but when it came down, there were all these fears of a lower than expected GDP growth for this entire year. And I think market has sort of discounted that because it is sort of seemed to be a backdated data which people knew about. But the geopolitical tension which have risen over the last 2-3 days, particularly yesterday night, I think there would be a sort of a cautious undertone in the market for the next 2-3 days. Liquidity was one part which was driving the emerging markets across. If this gush of liquidity stops, I think there will not be much of hope, at least for India, going into the budget as well as into the earnings season. I think the key monitorable would be the earnings season this time around, where probably the banks would lead the recovery or the lack of it. So this is where I think a lot of things would depend on the upcoming budget as well as the earnings season. Otherwise, the market which was having a complexion of buy on dips has sort of turned into sort of for a shorter term at least a sell on rise.
All right, so sell on rise coming in there according to Devang. Let's talk about specific stocks as well that you'll be focusing on, Devang. What's going to be on your radar?
We've been generally bullish on the insurance space as a whole. Life insurance as well as general insurance, both as a sector since last 1 year. Select MNC pharma companies, select consumer companies as well. And one of the biggest sector that we were backing on has been building materials, large caps, mid caps, both on this side, including paints, adhesives, sort of electrical goods. A lot of these companies have done well. Of course, with crude rising, there will be short-term tensions here, but a number of these companies have pricing power as well as competitive advantage. So we would be looking out for some companies where there would be fall on the back of a rise in crude prices. So we would be, I guess, buyers and accumulators over there.
It's a sharp recovery, very, very sharp recovery for SGX. 50 points is what SGX has managed to regain. When we walked into office this morning, SGX was down a good 2%. It is still down, but it's not out. I'm making this point again and again that the net impact of crude shock, at least for developed markets, is getting marginalized now. And that's very simple to understand. A couple of years ago, US was a net importer of crude. Now they are a net exporter of crude. So if crude prices, they go higher, and if the biggest consumer market in the world does not have dependency on crude, then on Middle East, so obviously the impact is going to be much less and much more nullified. I don't think the Middle East producers, especially in this case Iran, they also want to spoil their market. Their mother markets are India and China. India currently is importing from Iran. If crude prices remain elevated in both the economies, which is India and China, the demand has already contracted. High crude prices will only contract the demand further. So nobody wants to risk that. So bear these factors in mind. What happens today will be sentiment. Overbought market was looking for a reason to correct. That may well happen. You may see a bit of dislocation in large cap stocks, largely because the flow dependence could get exposed. But the dependence of the world on the Middle East crude, at least from United States, I think seems to be reducing, a point which we really need to consider. CK, I want to go back to why exporters, which is IT and pharma, have not taken off the block. Historical correlations are very simple to understand. Crude goes higher, IT and pharma, they roar. Right now, they are not even jumping.
Good morning, Nikunj. And I do believe that has much to do with the way the currency is poised right now. Now, if you look at, let's say, the rupee dollar chart and look at what has been the forecast that you have got for the rupee dollar chart, I think most of the larger players have generally veered to the consensus that there would be continued flow into India, and therefore the rupee is not going to really weaken very much. And if I recall correctly, the broad consensus was that there would be something like a 3 to 4% kind of weakening. So essentially everybody is calling for a weakness towards something like 73, 74 for the rupee as being the worst case. Now that does not really add too much to the kitty perhaps. I mean, I don't know the math on that, but I would believe that a very gradual weakening of the rupee across the year will not add too much to the bottom line, because these are long-term contracts that most of the companies get into for their services or for the import. Now, if you look at the dollar, on the other hand, if you look at the DXY index, then you see that that is not something which is showing very great deal of bullishness either. So this is a little unusual situation here, where there are geopolitical tensions and the dollar is not showing the kind of picture that it would otherwise have. Now, even if you look at the news flow, Iran going to retaliate, has retaliated, etc., etc. And if you look at today morning's price of both Brent as well as light sweet, you are finding that crude prices have not really spiraled. Gold has looked up, say, about $10 from yesterday, but gold is already on a bullish wicket, so that is not really something out of the ordinary. I would think oil is the most sensitive, or should be the most sensitive, particularly involving Iran. So people are taking a kind of holistic view, where if oil does not spiral, if gold, if the dollar does not really move up aggressively, and gold prices do not get out of control, I don't think people are taking a view that the rupee is really going to crap out, in which case only you will find there will be a big rush towards export oriented companies.
And the earnings season gets delayed because TCS has got some other legal issues to deal with because of what's happening between the Mistries and the Tatas. So in the absence of no Q coming from TCS, what is the big number markets would look forward to? Devang?
Yeah, Nikunj. I think clearly in the sense that rate sensitives as well as TCS as well as all these IT and pharma companies not doing well, there can be a bit of correction in the sense banking as well as the other pockets have been quite strong over the last couple of months. I think there will be clearly if there is lack of buying, there is lack of liquidity, earnings would be the only driver going forward. So my sense is in the next 15, 20, 25 days as the earnings season unveils, individual stocks will come to the fore and perform well or lack of performance, in the sense that companies come up with numbers and the management commentaries are more important than numbers. As we see crude spiraling in January, February, March, if at all crude spirals, then probably the fourth quarter numbers would be weak, and third quarter the guidance would be sort of again a little more weak. So our sense is that you will get a lot of opportunities in this quarter to buy. Budget is also on the anvil, as well as earnings season. This too will be key monitorables. Of course, geopolitical tensions, nobody can make any sort of a call, and it can go haywire as I talk right now.
Okay, we spend disproportionate amount of time discussing Kotak Mahindra Bank and ICICI Bank. These days it's fashionable to talk about Yes Bank, but the real star has been IndusInd Bank, 35x in 10 years.
Yeah, you can attribute that I would think to both the overall trend in private banks as well as the fact that IndusInd itself was really scorching up the roads alongside over the past many years. But what is significant, I would add here, is what it has done after ratcheting up that kind of return. It reached almost about 2,000 rupees back in August or thereabouts. Now, in contrast to, let's say, all the other banks, Axis, ICICI Bank, HDFC, Kotak, IndusInd Bank has somehow taken a reverse path, and that is what is a little bit of a niggardly worry. Now, if you were to club IndusInd Bank with the other private sector banks which you were, and then which it was very well correlated, things were fine till the middle of last year. But then suddenly from the some middle of last year, IndusInd Bank seems to have taken a completely different path. It's very definitely an underperformer when you compare it with the others. Now, this cannot happen for a sustained period of 6-7 months without there being an underlying reason within whatever is happening at IndusInd Bank. So, behind let's say facade, I mean facade is not a fair word. Behind the veneer, let's say, of being a private sector bank, there seems to be something amiss here, and that is what I would want people to take cognizance of, or at least notice of, that IndusInd Bank's trends have changed compared to what we are currently seeing still for all the other private sector banks, and that may be something that we may have to deal with down the road, because currently nothing seems to be really out in the open. So if I have to look at investments, and I've been a long-term holder in IndusInd Bank, I would say I am happy to fold my tent and go away to some other investment. If I want to buy into something and I'm looking at the pullback and say, hey, this is giving me a buying chance, I would want to see a little more evidence that things are not really amiss here.
The view coming in on IndusInd Bank, but let's also get in some more trading calls from our chartists. To the mid-cap ideas then, and Dr. Narayan, what's on your radar?
Well, I would continue to look for some selling opportunity. I think the pretty decent rally in L&T Finance has ended, and the stock was maintaining a nice downsloping channel on the charts. And when it rallied up recently to this 117-18 levels, it hit the top end of the channel. And here we are with the market poised a little weakish. So I think the channel should work and send the prices a little lower. So I would expect L&T Finance to have some weakness, sending it down towards 110 levels. So that's a short with about a 3 rupees stop loss.
Right, that's a mid-cap bet, and yes, that stock has been very active of late. Moving on then, Manas, with what we're expecting in trade today, what's the mid-cap call?
One in mid-cap, I would like to go with the Ramco Cements, because I see a lot of strength over here, because I think just few days back, it took support near to 200 moving average. Yesterday, it broke the resistance of 780 with higher volumes. So I think the correction phase is over, and the possibility is high that stock can again test 820, 825. So here one can create long position with stop loss of 759.
Right, and finally, let's get in your mid-cap pick, Kunal.
It's not really a mid-cap stock, but it's from the IT pack, which I believe looks very attractive. We've been discussing NIIT Tech, Mindtree as well, but I believe Tech Mahindra has also shown signs of bullish strength over the last couple of days. Bounced back from its 50-day moving average. Yesterday also showed good strength in terms of price. Would suggest a buy in Tech Mahindra for an immediate target of 800 and stop us at 765.
I also want to pick up another stock which has done rather handsomely well in last 1 year. That's InfoEdge. Why InfoEdge has done well? Well, they've got Naukri.com in it. But apart from that, they have investments in Zomato. They've got other investments like Policy Bazaar. And they're one company, if you're talking about disruption, InfoEdge is embracing a disruption because they're buying into companies which are which are in a sense really disrupting the entire supply chain, or the way how Indians would consume or they would buy insurance policy. So they are really investing into companies which are future disruptors. Devang, at a P multiple of 60-70 times, does it make sense to still stay invested in InfoEdge?
Nikunj, I think clearly it's a sort of a premium that this company is commanding, and you know that in US and the developed markets you find a lot of such companies which are disruptors, and there is a lot of appetite to buy such companies. Unfortunately, in the Indian arena, you don't find a lot of such companies being in the listed space. You have to venture out into the private equity markets as there are a lot of startups which are available over there. So in the listed space, as I said, it's clearly a sort of a premium which this type of company companies which are listed and are prowling for more companies which are disruptors rather than companies which are disruption proof. So Naukri or Info Edge rather would command this type of a premium, as it's been very aggressive in terms of acquiring other companies and generally been delivering on numbers. So it's more of a scarcity type of a premium which this company commands. Of course, with IRCTC again coming into the fore, which again is not again a railway company as a lot of people put it, but it's more a sort of a disruptor or an online monopolistic type of a travel booker for railways, as well as providing catering as well. So I think this type of companies would sort of command that premium. And to answer your question, yes, Info Edge can keep on doing well so far as it delivers its on its numbers.
Okay, that's on Info Edge. Kunal, just want to get a check on Mindtree. I mean, it's not the first time we've seen Mindtree seeing this kind of move in the last couple of months, but once again back in the spotlight. What are you making of it?
Yeah, I think 4 months of sideways action. I think from mid of August, the stock had gone to a 25-35 point band. 700-725 was the range for Mindtree. I think last month is where the stock gave a very strong breakout. So volumes came back for the stock. It's bounced back again, almost 10-15% from its 700ish kind of range. And also, I think more importantly, the stock has confirmed a break above its 200-day moving average. So that underperformance which was there as compared to the other mid-cap IT peers like NIT Tech and many of these other stocks, I think Mindtree is trying to play that catch up. And I believe it's happened with a very stable and steady uptrend rather than more of a vicious price uptrend for a couple of days. You see the stock going up higher. It's been more steady, and which is why I believe that the chances of the stock trend lasting is pretty much high for Mindtree. So I think from current levels, I would expect a steady growth by another 8-10%. So almost 900-910 is where I would place a target, but given a time frame of at least 1.5 months.
Okay. Just want to mark yesterday's construct as well. Cement was your one moving part. OMCs were the ones, even after, that bit of a recovery playing out to start off trade with yesterday, they again turned sides and they were weak. Then, of course, IT was like a bit of a limbo. After yesterday's traction, or rather day before's traction, Friday that is, you saw IT actually take a bit of a breather yesterday. Infi was actually down by about 2%. CK, is it a Friday-like construct that we're going to be looking at, where IT is the only island of safety and banks, financials, OMCs, all oil sensitives take a hard hit?
Well, that would be most logical kind of conclusion, because if tomorrow, given all this situation, oil were to spiral and rupee were to weaken, then like we just discussed a little while ago with Nikunj, then one would go to, and IT traditionally has been the defensive harbor, and pharma might get added to it, but pharma has been under pressure for various different reasons. Now here is an interesting thing, just give me about 15 seconds. Here is an interesting thing. If you look at the relative chart between pharma and IT, you will find that, they will typically, if you do a relative analysis, they will typically go to about, let's say 30-40% kind of variance between the two when both are trended in different direction. That differential has now increased to something like 80-90%, which means that IT has stayed put. Not that IT has really run away, but pharma has really got beaten down significantly. So between the pharma index and the IT index, now there is a very, very wide chasm. So it seems more likely that if you have to flight towards the defensive bets, good pharma companies, good in the sense what is perceived by the market to be good, I think those will also attract an additional amount of interest. I would think stocks like Dr. Reddy, Divi's Lab, etc. These are some of the companies which can also be looked upon as being defensive bets along with the traditional flow of money into IT.
3.5 minutes to go. I just want to go back to the Trump from US President Donald Trump. Very, very clear that nobody wants a war. This is pure retaliation. In a trade war, no one has won. In a geopolitical war, there are going to be no winners clearly. Does the Republican administration risk geopolitical mess which will impact the economy and the global growth in a year when there are US presidential elections? Maybe not. It's been such a great economic run for the US economy that nobody would even think of shaking the apple cart. So these minor disturbances in the Middle East, I don't think right now have potential to flare up into something very big. That's my view. Second, I've been maintaining this, which is that, folks, let's be very clear. US is the net exporter of crude now. It's not the 80s, it is not the 70s, it is not the 90s, where US was dependent on Middle East for their energy needs. And then the energy need in the world has reduced, largely because India and China, they both are slowing down. Fossil fuel has been replaced, fossil fuel could get reduced because of electric vehicles, solar energy, and also the revolution of shale gas. So unlike when the oil shocks have really shaken the world equity market, this time around it may just be more tempered, looking at how the crude consumption patterns have really emerged in the past.